During the speech you gave in Jackson Hole, Wyoming in August, you spoke about the challenges, given the Fed's dual mandate, of navigating the stars, U star, the neutral unemployment rate, and R star, the neutral interest rate. On the one hand, the wage growth figures reported since then suggest that both U star and R star are below their neutral rates. On the other hand, asset prices, which you mentioned, have fallen significantly since August, leading a number of observers, some louder than others, to argue that financial markets are signaling a weakening economy ahead. In light of the new data since August, have you changed your views about either the true level of R star or the speed with which you and your colleagues should navigate towards it?
Thank you, Peter. So the point I was trying to get across at Jackson Hole is that we do make monetary policy to some extent by way of these stars. And these starred variables, like the natural rate of unemployment, the neutral rate of interest, give us a benchmark against which to measure policy or to measure unemployment. How do we know whether unemployment is low or high? We have to think that there's a natural rate. And so we need these estimates, but we understand that they're highly uncertain. So we have to have them, but we have to also take on board that they're uncertain, the actual locations of them. And so also we need to constantly update our thinking based on incoming data and from the financial markets and from the real economy. So we do constantly update them. In fact, if you look back, each FOMC participant publishes his or her estimate of these variables 4 times a year in what we call the Summary of Economic Projections, and we'll be doing that again in December. And over the last 4 years, you've seen estimates of the natural rate of unemployment decline very substantially for just the reason you point to, and the same for the neutral rate of interest. So we're learning all the time that after the crisis, these variables are at different levels, and it does complicate policy, but that's the world we live in. So in that world, what do you do when you're uncertain about the variable? Well, and I liken it to walking into a room full of furniture like this and suddenly the lights go out. So what do? You slow down and you maybe go a little bit less quickly and you feel your way more. That's just the thought, is that you feel your way more. So under uncertainty of this kind, you be careful. And I think that's what we've been doing with monetary policy for some time. We've been moving gradually in a way. It's a way of keeping those risks at bay and learning as you go. So you ask, so we're always updating those. You made a connection to recent financial market events. I think we're always looking for signals. I think it's too soon to say. These are variables that move slowly over a long period of time. They don't move quickly. These are thought to be underlying aspects of the economy that are slow moving. So I don't know that you would change them based on financial market volatility, but at the end of the day, you'll take into account lots of different information.